All right, welcome back to the deep dive. And I hope you are sitting down for this one.
Yeah.
No, I'm serious. If you're standing up, maybe find a chair. If you're driving, please keep your eyes on the road. But maybe grip that steering wheel just a little bit tighter.
It has been a week, hasn't it? A brutal week.
A week. That is putting it mildly. That's like, I don't know, saying the Titanic had a bit of a moisture problem.
Minor leak.
A minor leak, exactly. Look, check your calendar. It's Friday, February 6th, 2026. And if you've had the courage to look at your brokerage app, your 401k, or really just the news in general, you know that the financial world looks like a crime scene today.
It certainly does. There's a sea of red on the screen. It's not just a correction. This feels like a reckoning.
We are talking about a historic wipeout. And I want everyone listening to just visualize this for a second. We are talking about $1 trillion.
1 trillion with a T.
With a capital T.
Yeah.
$1 trillion wiped off the books of big tech in a single week. Evaporated.
Yeah.
Gone. Just vanished into the ether.
It's hard to even conceptualize a number that big.
I was trying to wrap my head around it before we started recording. If you stacked 1 trillion $1 bills, I mean, the cliche is that it reaches the moon, but it's true. It's an astronomical amount of money.
It's the entire GDP of a country like Switzerland or Argentina, just gone from the balance sheets of a few companies. It's mind-boggling.
Exactly. And the question on everyone's mind, the question makes you hesitate before you log into your E-Trade account, is this. Is this just a bad week? Is this a blip? Or is the party actually over?
That's the trillion-dollar question, isn't it?
It really is.
Yeah.
So welcome to Theta Fuse. This is the deep dive for the active trader, for the people who want the alpha without all the corporate speak. We're going to unpack exactly what happened, why your portfolio might be trying right now, and more importantly, where the opportunity is hiding in all this rubble.
And there is opportunity, even in a market like this. Sometimes, especially in a market like this, that's when the signals get really clear.
That's the spirit. But first, we have to play corner. We have to understand the mechanism of the crash. What exactly triggered this landslide?
Well, what we're seeing is a classic case of, I guess, what sociologists and economists would call sentiment contagion.
Sentiment contagion. It sounds like a virus.
In a way, it is. It functions exactly like one. It starts with a small cluster of information, in this case, some pretty shocking earnings reports.
Okay.
But then it spreads. It mutates from a specific concern about, say, spending into this broader, almost existential fear of an AI bubble. Investors woke up this week, they looked at the numbers, and they suddenly asked this collective question. Wait a minute. Are we paying way too much for promises and not nearly enough for actual tangible profits?
The show me the money moment, the Jerry Maguire moment for Wall Street.
Precisely. And when the market shouts, show me the money, and the answer from a CEO is, just wait until next year, trust me. Well, the punishment is swift and it is severe.
Okay, so here's the lineup for this deep dive. We have a packed roster to get through if we want to make sense of this mess.
A lot to cover.
A ton. First up, we're going to the front lines of the Battle of the Cloud. We have Amazon, who is spending money like it's going out of style, versus Google, who seem to be printing it.
That divergence is the single most important signal in the market right now. It tells you everything you need to know.
Then we're going to wade into the crypto crash. Bitcoin was teasing $60,000, and not in a good way. And we have the company's strategy, formerly known as MicroStrategy, taking a loss so big it's hard to believe.
A truly staggering loss. One for the history books, no exaggeration.
And after that, we'll check in on the old world. If you think tech is having a bad day, just wait until you hear about Stellantis.
Whoa, that's a car wreck in every sense of the word.
They crashed 27%. And finally, some bright spots. Believe it or not, there are some green shoots in this scorched earth. Reddit and Roblox are defying gravity.
It's a fascinating divergence. The content creators and the community platforms are winning, while the infrastructure builders and the heavy manufacturers are just bleeding out.
So let's get right into it. Segment 1. The $200 billion gamble. We have to talk about Amazon.
We do. It's the elephant in the room, the 800-pound gorilla.
Shares plunged. I mean, depending on when you look, it was down anywhere from 8 to 11% after hours and in the pre-market. That is a massive move for a company the size of Amazon.
We're not talking about a penny stock moving 10%. That's hundreds of billions of dollars in market cap, just poof, gone.
And the culprit, the word on everyone's lips, seems to be this little acronym, CapEx.
Capital expenditures.
Okay, let's stop the flow for a second and unpack this. I hate jargon. CapEx sounds so boring. It sounds like something an accountant mumbles while he's looking at your taxes. But right now, it is the most important word in finance. How do we explain this to someone who doesn't stare at balance sheets all day?
Okay, think of it like a restaurant. Let's say you own a very successful pizza place. You're making good money, the neighborhood loves you, you're selling pepperoni slices left and right.
Okay, I'm with you.
But you have a vision. You decide that next year you want to serve 10 times as many customers. You think the whole city is going to want your pizza. So you take all your profit, every single dime you made selling pizza this year, and you spend it on a massive renovation.
So I'm emptying the register, basically.
You are emptying the register, you're maxing out the credit cards, you buy 10 new industrial-sized ovens, you knock down a wall to double the size of the dining room, you buy a whole fleet of delivery trucks, you upgrade all the plumbing and electrical.
Okay, so if I look at your bank account today, on Friday, it looks like you're broke.
Exactly. You spent the money now for growth that you hope will come later. That money you spent on the ovens and the trucks, that's your CapEx. It's an investment in future capacity. It's not lost money. You have the ovens, they're assets, but you don't have the cash anymore.
Okay, so Amazon is the pizza place. And they just bought a lot of ovens.
A lot of ovens. Amazon came out and announced a plan to spend $200 billion in 2026 on CapEx.
200 billion.
Yeah.
That's a number that doesn't feel real.
It's hard to comprehend. To put it in context, that is $50 billion more than Wall Street was expecting. The analysts, the people whose entire job is to predict these things, they were modeling a big number, maybe 150 billion.
Which is already a crazy number.
An insane number.
Yeah.
And Amazon came out and said, nope, add another 50 billion to that. We're spending 200.
And the market freaked out.
They did. Because if there's one thing investors hate, it's uncertainty. They see $200 billion going out the door, mostly for data centers, custom AI chips, networking gear for AWS, but they aren't seeing the immediate profit to justify it yet.
It's the pizza shop owners' investors standing there and saying, hey,
Where's my dividend? Where's my profit check from last year? And the owner says, don't worry, we're going to sell so much pizza in 2027, you won't even believe it.
and in this market, trust me, isn't good enough anymore, is it?
Not when you're talking about that scale of spending. We're seeing plans across all of big tech to funnel something like $660 billion into AI this year. That figure alone is higher than the GDP of countries like the UAE, Singapore, or Israel.
That is just wild. The tech giants are spending more than entire nations produce in a year.
It's a new kind of arms race.
But Andy Jassy, Amazon CEO, he isn't backing down, right? I read the transcript of the earnings call. He sounded pretty defiant.
He was very confident. He used a very specific phrase that I thought was interesting. He said, this isn't some sort of quixotic top-line grab.
Quixotic, that's a good word. Don Quixote. Meaning he's not just chasing windmills. He's not crazy.
Right. He's arguing that this is necessary, defensive spending. He believes the returns will be there. He actually mentioned that AWS, their cloud unit, is supply constrained. They literally cannot build data centers fast enough to meet the demand they're seeing from AI companies.
So in his mind, he's actually leaving money on the table if he doesn't spend this $200 billion. If he doesn't build the gym, the bodybuilders will just go lift somewhere else.
That's his argument exactly. And he used another interesting analogy to describe the AI market. He called it a barbell.
A barbell, okay, and unpack that for me. I love a good analogy.
So picture a weightlifting barbell. You have the big heavy weights on the left side and the big heavy weights on the right side.
Get it.
Jassy says on one side of the barbell you have the AI labs, companies like OpenAI, Anthropic, the people building the massive foundational models. They need huge amounts of compute power. They're one end of the demand.
Those are the heavy lifters, the pros.
Right. Then on the other side of the barbell, you have the enterprises. Companies like banks, hospitals, big retailers. They just want to use AI to save money or be more productive. They aren't building the models, they're applying them.
Okay, so you have the makers and the users. And where's the middle?
That's the handle of the barbell. And Jassy says right now the market is top-heavy. It's all concentrated on the ends. But he believes the middle companies, taking those big models and building very specific applications for specific industries, is going to become the biggest part of the market. And Amazon wants to own the infrastructure for that entire barbell, the ends, the middle, everything.
They want to be the gym where everyone lifts. They want to own the floor, the weights, the squat rack, the water fountain, everything.
That is the plan. But the problem, again, is that building that gym costs $200 billion today, and the membership fees haven't fully rolled in yet. That's the disconnect. The market sees the bill today, but the revenue is just a promise for tomorrow.
And we keep hearing this term hyperscalers. We should probably clarify that too, just so nobody feels left out of the cool kids club.
Sure, yeah. Hyperscalers just refers to the massive cloud providers who operate at a scale that, basically no one else can touch. We're really talking about three companies: Amazon's AWS, Google Cloud, and Microsoft's Azure.
The big three.
The big three. Maybe Oracle is sort of knocking on the door, but it's really those three. They're the only ones with pockets deep enough to even play in this $200 billion sandbox.
So Amazon is betting the farm, or at least a very, very large portion of the farm, that this AI boom is real and durable, but the market just punished them for it. Now, let's pivot, because this is where the story gets really interesting.
It is.
We have Amazon down big, but then we look at Alphabet, Google's parent company.
Yep.
They held up relatively well, down maybe 2%, while Amazon's down 8% or more. Why the massive difference?
It's the Google counterpunch. And the difference, really, it comes down to one single word: profitability.
Show me the receipts.
Exactly. Amazon is promising to win the championship next season. Google just walked into the press conference with a gold medal already hanging around its neck.
Haha, I like that. Break down the numbers for us. Why is Google getting a pass from Wall Street on this?
Okay, so Google Cloud revenue hit $17.7 billion. That is up 48% year over year. That is massive, massive growth for a company that size.
That's a huge number.
But here's the kicker. More importantly, look at the operating income from the cloud division: $5.3 billion.
So they aren't just selling cloud space at a loss to gain market share. They are making a healthy profit on it.
A very healthy profit. That's a 154% increase in operating income year over year. That is the key. Google is demonstrating that their AI investments are already paying off. They aren't saying, give us $175 billion and wait. They're saying, look, we spent the money, and here is over $5 billion in profit to prove it worked.
That is a huge psychological difference for an investor, isn't it? It changes the entire conversation from one of speculation to one of validation.
That's a massive difference. It signals execution. And there's another factor here, which is Gemini.
Google's AI model.
Right. For a long time, the narrative was that Google was behind, that OpenAI and ChatGPT had eaten their lunch. People thought Google was the sleeping giant that just missed the alarm clock.
Yeah, that was definitely the story for most of last year.
But the data from this quarter suggests that narrative is shifting. Gemini is actually taking market share. It is now the second largest chatbot in the market, challenging ChatGPT directly. It's becoming a two-horse race.
So the idea that Google is a dinosaur is dying.
It is being rewritten in real time. And here's the most fascinating part. Google is also planning to escalate their CapEx.
Oh, really?
Yes, they're talking about spending between $175 and $185 billion in 2026. That is almost as much as Amazon.
Whoa. Okay, so they're spending almost the same astronomical amount.
Almost exactly the same, but because their cloud margins are exploding, because they can point to that $5.3 billion in profit, investors are giving them a pass on the spending.
That's fascinating.
It goes back to the athlete analogy. If an athlete buys the most expensive shoes and training gear, people might roll their eyes and say they're all flash. But if they go out and win the gold medal the next day, nobody cares how much they spend on the shoes.
Right, because the result justifies the cost.
Exactly. Amazon is buying the shoes. Google is wearing the medal.
That's a perfect way to put it. It really highlights how fickle this market is right now. It is not about how much you spend. It's about the story you can tell with the results and the immediate results.
And right now, Google's story is growth plus profit. Amazon's story is invest now for an even bigger future. In a fearful market, investors are going to choose the tangible profit every single time.
Speaking of fear, let's leave the relative safety of the cloud and head out to the Wild West. Segment 3. Are we in a crypto winter in February?
It certainly feels like it. It feels like the air conditioning is stuck on polar vortex.
Bitcoin is bleeding. It bounced off the lows a bit this morning, but it narrowly avoided falling under that big psychological number of $60,000.
And we have to give that some context.
We do, because back in October, which was not that long ago, it was at $126,000.
That is a 50% drop from the peak in just a few months. That is a brutal bear market by any definition you can find.
If you bought the top, ouch, that is a world of pain.
That is a painful, painful drawdown. And we have to explain why this is happening because I think it breaks a lot of people's mental models about Bitcoin.
Right, the pitch was always digital gold.
Exactly. A hedge against inflation, a safe haven asset. When the stock market crashes, you're supposed to hide in gold or Bitcoin, right? That was the story.
That was the pitch. But it's not acting like gold at all. It's acting like a tech stock on caffeine. Or maybe something stronger.
That's exactly right. We're seeing a very high risk-on correlation. When the NASDAQ drops, when tech stocks get hammered, Bitcoin drops right along with them, often even harder. It is being treated as a speculative asset, not a store of value, at least in the short term, by the big institutions.
So the institutional money that everyone was so excited about, they're treating it like just another stock in their portfolio.
They're treating it like a high-beta tech stock. When they need to de-risk, it's one of the first things they sell. And this brings up a really important mechanic that keeps popping up in the news. Forced liquidations.
Yes, I saw that. $800 million liquidated on Friday. Can we explain that simply? Because I think that's what scares people, the speed of the drop. It feels so mechanical and violent.
It is mechanical. And it is violent. It's a snowball effect. So let's break it down. Imagine you want to bet on Bitcoin, but you want to bet big. So you borrow money from an exchange to buy more Bitcoin than you could actually afford with your own cash. That's called using leverage.
Okay, so I have $10,000 of my own money, and maybe I borrow $90,000 to buy $100,000 worth of Bitcoin. I feel like a genius when it goes up.
You feel like a king. Your gains are magnified 10 times. But the exchange you borrowed from, they aren't stupid. They have a rule.
Yeah.
If the price of Bitcoin drops by, say, 10%, your $10,000 of equity gets completely wiped out.
Right, my cushion is gone.
Your cushion is gone. And to protect their $90,000 loan, the exchange doesn't call you. They don't send a polite text message.
No warning.
No phone call, no email. Their system automatically sells your $100,000 of Bitcoin to get their $90,000 back. That's a liquidation. Now, imagine thousands and thousands of traders all leveraged up like that.
I see where this is going.
The price drops a little bit, which triggers a few of those automatic sell orders. Those sell orders push the price down further, which then triggers the next level of sell orders from other leveraged traders.
And down we go. A cascade.
That's a liquidation spiral. We saw over $2 billion worth of leveraged positions, both long and short, liquidated recently. It's like throwing gasoline on a fire. It turns a normal correction into a terrifying crash.
And speaking of crashes, we have to talk about the company formerly known as MicroStrategy. The reports are calling it Strategy now, though I think most of us still know it by the old name.
Yes, the ticker is still MSTR, but let's call them Strategy for the sake of the report.
They posted a net loss for the fourth quarter of $12.6 billion.
That is a staggering number.
I mean, I first read that, I thought it was a typo. $12.6 billion. How do you lose $12 billion in just 3 months?
It's no typo. It is one of the largest quarterly losses in U.S. corporate history. To put that in perspective, that rivals the kind of losses we saw from major banks during the 2008 financial crisis.
And this is all because the value of their massive Bitcoin holdings just tanked.
Primarily, yes. It's what's called an unrealized loss, for the most part. They didn't necessarily sell the Bitcoin and lose the cash, but accounting rules require them to mark the value of their assets to the current market price.
So when you hold, what is it, hundreds of thousands of Bitcoin?
An enormous amount. When you hold that many, and the price drops by $30,000 or $40,000 per coin, the math gets very, very ugly very fast.
But Michael Saylor, the executive chairman, he seems, I don't know, calm. I saw an interview with him. He did not look like a guy who just lost the GDP of a small island nation.
Saylor is always calm. He is playing a completely different game than the rest of Wall Street. He has what we would call an infinite time horizon.
He's not thinking about this quarter. He's looking at 2040, not 2026.
Exactly. He made a comment on the earnings call that really stood out. He said the price of Bitcoin would have to drop to, I think it was around $8,000. Yes, roughly $8,000, and stay there for years before they would have any trouble paying back their debts.
8,000. Okay, so from 60,000, he has a massive buffer.
A gigantic buffer. He's basically telling investors, we can survive a nuclear winter, don't worry about it. But for a trader watching the chart today or an investor looking at their statement, seeing the stock down 70% from its levels a year ago, that's painful.
It's the difference between conviction and pain tolerance, isn't it? Saylor has the conviction. His shareholders are the ones who need the pain tolerance.
A very high pain tolerance. You need a stomach of steel to hold that stock right now. It's a pure play bet on Bitcoin, and it moves like it.
And I noticed he also dismissed this quantum computing threat as FUD, fear, uncertainty, and doubt.
Yes, there's been some chatter in the crypto world that in the future, quantum computers could become powerful enough to crack Bitcoin's encryption. Saylor basically laughed it off. He called it a parade of horribles and said the technology is a decade away, if not more. He thinks Bitcoin's protocol will simply upgrade its security long before that ever becomes a realistic threat.
So not something to worry about this weekend, then.
Probably not. The liquidation spiral is the immediate, clear, and present danger, not a hypothetical quantum computer in 2035.
Fair enough. Okay, let's move from the chaos of the digital world to the seemingly equal chaos of the physical world. Segment 4, the old world versus the new world. And we have a perfect tale of two companies here. One makes cars, one makes, well, internet arguments.
And cat memes. Don't forget the cat memes.
Can't forget the memes. Let's start with the car wreck. Stellantis. For those who don't know, this is the parent company of Jeep, Fiat, Chrysler, Peugeot. They crashed 27%.
This is a brutal, brutal situation. They took a $26 billion charge to reset their business.
$26 billion. That's even bigger than the strategy loss.
It is, and it's what we call a kitchen sink quarter. They're basically throwing everything bad into one report and admitting that their entire strategy was wrong, specifically their EV strategy.
The big push into electric vehicles.
Right. They went all in, they built factories, designed models, and they completely overestimated how fast people would switch to EVs. They built all this capacity for a demand that just didn't materialize at the pace they expected.
The customers weren't there yet.
The customers weren't there. The new CEO, Antonio Filosa, was very blunt about it on the call. He cited poor operational execution.
That is the ultimate corporate speak for we messed up big time.
It is. They are scaling back the EV push, canceling models. It's a huge cautionary tale of the energy transition. It's not a simple straight lineup. If you bet the whole farm on EVs and the consumer says, actually, you know what, I'll stick with a hybrid or a gas engine for now, you get absolutely crushed.
It just feels like the old world of manufacturing is having such a hard time adapting to these shifts. It's so expensive for them to pivot.
It's incredibly capital intensive. You can't just update the software on a car factory. If you build the wrong factory to build the wrong car, you lose billions. You have to retool, you have to lay off workers, you have to break contracts with suppliers. It is incredibly messy and slow.
Now contrast that with the new world. Let's talk about Reddit.
Reddit is up 7%.
In a week where Amazon tanked, crypto imploded, and Stellantis crashed, Reddit is up. Why?
Because they are the ultimate new world resource. It's not steel or lithium, it's data.
Explain that. Why is Reddit flourishing while Jeep is stalling?
Reddit beat their earnings expectations pretty significantly. Revenue was up 70%. But the key is why it was up. Sure, general advertising demand is robust, but the real story is they are using AI to help marketers find hyper-specific niche communities.
So instead of just blasting an ad for a new video game to everyone, they use AI to say, hey, these 5,000 people in this specific subreddit really, really love vintage Japanese role-playing games. Show them this ad.
Exactly. It's incredibly efficient. And more importantly, because Reddit is the content, it's just millions of people talking about their passions all day. They own the data that all these AI models need to train on. They are sitting on a goldmine of human conversation.
It's the same story with Roblox, right? You mentioned they were up about 11%.
A very similar story. Strong bookings. Roblox is a platform where the users themselves create the games. So again, the company just provides the venue, the digital real estate, but the users create the value.
There is a definite theme here, isn't there? The companies that are making the content or providing the platform for it, like Reddit and Roblox, they're winning. The companies that are organizing the world's data, like Google, they're winning.
But the companies building the physical infrastructure, like Amazon's data centers, or making the heavy hardware like Stellantis' cars, they're the ones struggling right now.
It's the difference between asset heavy and asset light.
That's exactly. In a high interest rate, uncertain world, Wall Street loves asset-light businesses. Reddit doesn't need to spend $200 billion on servers or build massive car factories. They just need to keep the servers running and, let us argue about politics and look at cat pictures.
And that apparently is a very profitable business model. Who knew?
It's the ultimate renewable resource. Internet opinions.
I love it. Okay, quick detour. Let's hit the commodities corner before we get to our strategy. Segment 5, let's talk about silver.
The poor man's gold.
It didn't feel very golden this week. It was all over the place. It dropped nearly 10% in a flash and then snapped right back. What on earth is happening with silver?
This is a fantastic lesson in a term we hear all the time: liquidity.
Okay, jargon buster time. Liquidity.
yeah.
We hear it all the time. Liquidity crisis, low liquidity. The Fed is adding liquidity. What does that actually mean in plain English?
Okay, imagine you have a very rare baseball card, a 1952 Mickey Mantle rookie card.
I wish.
We all wish. If you take that card to a sold-out stadium that's hosting a massive sports memorabilia convention, you can sell it instantly at a great price.
Right. There are thousands of buyers right there.
That is high liquidity. There are lots of buyers, lots of sellers. The price is fair and stable. You can get in or out of your position instantly.
You just need to move the asset.
Right. Now, imagine you try to sell that same priceless card in an empty room, or a room with just 3 other people in it who might not even be that interested. To sell it, you might have to drop the price drastically, just to tempt one of them to make a bid. That is low liquidity.
So silver was basically in the empty room this week.
Basically. The reports say silver suffered from extremely low liquidity, and the trigger was apparently a wave of Chinese selling ahead of a national holiday. When there aren't enough buyers on the other side to absorb all those sell orders, the price just gaps down. It falls off a cliff.
An air pocket.
A total air pocket. It lost nearly 40% from its January peak at one point, before snapping back when the bargain hunting buyers finally stepped in and filled the void.
It just goes to show that it's not just about the asset you own. It's about the market for that asset. If nobody's in the room to trade, the price on your screen isn't really real.
Exactly. And in volatile vids like this one, liquidity dries up fast. Everyone gets scared and steps back from the market. They leave the room. And that's why you see these crazy violent swings.
Okay, we have covered a lot of ground. The trillion-dollar haircut, the Amazon CapEx gamble, the Google receipts, the crypto winter, the Stellantis car wreck, the Reddit rise. Now we have to land this plane.
We do.
This is Theta Fuse. We don't just admire the problem. We look for the play. Based strictly on the news we have discussed today, what is the move? What is the investment strategy of the day?
Amidst all this carnage, there is one signal that is flashing very, very clearly to me. And it comes directly from that divergence we talked about between Amazon and Google.
Okay.
I'm calling it the cloud resilience play.
Break it down for us. What are we looking for?
Look, the market is punishing what I'd call naked spending. If you are spending billions and just promising results down the line, you get hit. That's Amazon right now. It's a show me story. And they don't have the receipts yet.
Okay.
But the market is rewarding spending if it is accompanied by immediate, tangible margin expansion and revenue growth. That is Google.
So the logic is go where the profit is already visible. Don't chase the promise, chase the receipt.
Exactly. So the play is to look at Google. Google flew. Let me give you 3 clear reasons. Reason 1, 48% cloud growth. They are absolutely crushing estimates and taking market share. The narrative has shifted.
Okay, that's the growth story.
Reason 2, the valuation is still relatively undervalued, specifically for this cloud profitability. The market was pricing them as a loser in the AI race, and they just proved they're a clear number 2, maybe even co-number 1. There's room for the price to catch up to that reality.
So a valuation re-rating.
Exactly. And reason 3, and this might be the most important one today, resilience. The stock held up, down only 2%, while others in its cohort tanked 8, 10, even 27%. That relative strength is a huge signal. It tells you that the big institutions are not selling it. They're holding on, maybe even buying the small dip. It's become a defensive play and a tech wrapper.
It's the steady hand in the storm.
Precisely. And just as a contraindicator, a note of what to avoid, I would absolutely avoid catching the falling knife on Bitcoin or silver right now.
Don't try to be a hero and buy the dip just yet.
Not right now. When you see $800 million liquidations, you step back and let the storm pass. Let the weak hands get flushed out. Stick to the cash flow machine that is Google Cloud. It's the safer, smarter play based on this week's hard data.
I like it. It's disciplined, it's data-driven. But before you go out and buy anything based on what we just said, we have to say the magic words.
We absolutely do. The content of this podcast is for informational purposes only. Everyone's financial situation is different, and the thoughts we provide here may not be applicable to you. We are not financial advisors. Please consult with a professional before making any investment decisions.
Can't say it better or more clearly than that. So as we wrap up, let's just zoom out for a final thought. We started with the $1 trillion wiped off the table. We ended with a strategy to find resilience in the middle of the storm. What's the final thought? The so what of this whole bloody week?
The so what is this? We are officially in a show-me market. 2025 was the year of AI promises. It was the year of flashy press releases and grand 5-year visions. 2026 is the year of AI receipts.
The bill has come due.
It has. If you can show the market the receipt, if you can show the profit, the margin expansion like Google or Reddit did, the market will reward you, even in a downturn. But if you can't, if you're just showing a bigger spending plan like Amazon or a massive loss like Strategy, the market will punish you no matter how big or popular you are. The era of free money and blind faith in visionary CEOs is over.
Which leads me to a final provocative question for everyone listening. Is the $1 trillion wipeout we just witnessed a bubble finally bursting? Or is it the best buying opportunity of the decade?
That is the trillion-dollar question, isn't it?
Indeed it is. Keep your eyes on those receipts, folks. Keep your theta positive and your fuse lit. We'll see you on Monday.
See you then.